Silver just did something it hasn't done in decades. While you were sleeping, the price exploded past $93 an ounce. That's not a typo. $93. And here's what nobody's telling you. It's not coming back down to where it was. Not to $77. Not to $50. Maybe not ever. You want to know why? Because the largest companies on Earth just realized they have a problem. A supply chain panic is unfolding right now, and silver sits at the center of it. Tesla needs it. Samsung needs it. Every solar panel manufacturer on the planet needs it. And there's not enough to go around. Let me show you what's actually happening. Because this isn't about speculation or hype. This is about mathematics, physics, and a market that's been running on borrowed time for 5 years straight. Here's what kicked this off. Just weeks ago, Elon Musk made headlines with a massive corporate bid tied to strategic supply chain positioning. We're talking tens of billions in capital deployment. Now, whether that exact figure was $91 billion or part of a broader acquisition strategy doesn't matter as much as what it signals. The world's richest man, who runs the largest electric vehicle company on Earth, is making moves that scream one thing: supply, security, and what does Tesla need more than almost anything else? Silver. Lots of it. Every single Tesla vehicle rolling off the production line contains about 1 ounce of silver in its electrical systems, charging infrastructure, and motor components. Multiply that by millions of vehicles per year, and you start to see the problem. But it's not just Tesla. Look at what's happening across the entire tech sector. Apple, Samsung, every major electronics manufacturer, they all depend on silver for conductivity. It's the best electrical conductor on Earth. There is no substitute that performs at the same level. You can't innovate your way around the periodic table. And then there's solar. This is where the crisis gets real. Every solar panel uses silver paste to conduct electricity. The green energy revolution everyone keeps talking about. It runs on silver. China alone installed a record amount of solar capacity last year. The International Energy Agency projects global solar installations will double by 2028. Each megawatt of solar capacity requires approximately 2,500 ounces of silver. Do the math. We're looking at industrial demand that's climbing into the stratosphere, while mine production has been essentially flat for years. Now let me tell you about the enemy in this story. And make no mistake, there is an enemy. It's not a person, it's a system, the paper silver market. For decades, the price of silver hasn't been set by actual physical metal changing hands. It's been set by contracts, by derivatives, by promises written on paper. The COMEX, the world's largest silver futures exchange, has been running a fractional reserve system, where the same ounce of silver backs multiple claims. Think about that. If you and I both think we own the same ounce, and we both try to take delivery at the same time, someone's walking away empty-handed. And this isn't conspiracy theory. In September 2020, J.P. Morgan Chase paid $920 million to settle charges with the Commodity Futures Trading Commission. The charge, spoofing, manipulating precious metals markets for 8 years straight. They placed hundreds of thousands of fake orders to move prices, then canceled those orders before execution. The CFTC called it manipulation. That significantly benefited JPM and harmed other market participants. That's not my opinion. That's the federal government saying one of the largest banks in the world was caught red-handed, rigging the silver market. But here's the thing. Even after paying nearly $1 billion in fines, the system didn't change. The paper market still dominates price discovery. Until now, because something's breaking. Let me show you the proof. Not speculation, not predictions, just data. First, look at the COMEX vaults. These are the physical warehouses in New York where silver backing futures contracts is stored. There are 2 categories: eligible and registered. Eligible means the silver is sitting in the vault but not available for delivery. Registered means it's actually available to settle contracts. As of mid-January, registered silver at the COMEX dropped below 120 million ounces. That might sound like a lot, until you realize that open interest, the number of contracts demanding delivery, represents over 150 million ounces. The math doesn't work. There's not enough registered silver to cover the contracts. In December alone, 63 million ounces stood for delivery. That's the highest monthly total on record. People aren't trading paper anymore. They're demanding the physical metal. And every time someone takes delivery, the registered inventory shrinks. Second proof point. London lease rates. This is the cost to borrow silver in the wholesale market. Under normal conditions, silver lease rates hover near zero, maybe 0.5% annually. In October, those rates spiked to 35%. 35% to borrow silver for 1 month. You know what that means? It means there's a scramble for physical metal in London, the world's largest bullion market. When lease rates explode like that, it's because someone, somewhere, got caught short and needs silver immediately. They're willing to pay almost any price to get it. As of early January, rates have eased to around 3.3% annualized. That's still 6 times higher than normal. The market is still tight. The shortage is still real. Third proof point. Retail premiums. Go to any major bullion dealer right now. COMEX, JM Bullion, SD Bullion. Look at the premium over spot price for a 1-ounce silver coin. You're looking at $10 to $12 over spot, sometimes higher. That's a premium of more than 10%. 5 years ago, you could buy silver for $2 over spot. The premium has increased by 400 to 500%, while the spot price has climbed. That tells you, physical demand is overwhelming supply at the retail level. Dealers can't keep inventory in stock. When silver rallied past $90, some dealers reported wait times of 6 to 8 weeks for new orders. Fourth proof point. Market backwardation. This is a technical term, but it matters. Normally, futures contracts trade at a premium to the spot price because there's a cost to store and insure silver over time. That's called contango. But for extended periods over the last year, silver has been in backwardation. That means the spot price is higher than the futures price. Traders are willing to pay more for silver today than for silver delivered months from now. That only happens when there's a shortage of physical metal right now. Fifth proof point. The supply deficit. According to the Silver Institute's World Silver Survey, the global silver market posted a deficit of 149 million ounces in 2024. That's the 4th consecutive year of deficit. Over the past 5 years, the cumulative deficit approaches 820 million ounces. Let that sink in. For 5 straight years, the world has consumed more silver than it's mined and recycled. Where did that 820 million ounces come from? Above-ground inventories, stockpiles, and those stockpiles are running dry. This isn't new. This is history repeating itself. And if you know the history, you understand why silver never goes back to where it was. Let me take you back to August 1971. President Richard Nixon went on television on a Sunday night and announced that the United States would no longer convert dollars into gold. He closed the gold window. It was called the Nixon shock. Why did he do it? Because the system was breaking. After World War II, the Bretton Woods Agreement pegged global currencies to the dollar, and the dollar was pegged to gold at $35 an ounce. But the U.S. had been printing dollars faster than it had gold to back them. Foreign governments started demanding gold, and the U.S. was running out. So Nixon did the unthinkable. He severed the link. Overnight, the dollar became pure fiat currency, backed by nothing but trust in the U.S. government. What happened next? Gold exploded from $35 to $850 within a decade. Silver went from $1.50 to $50. That's a 3,300% increase for silver. But here's the critical lesson. Once the system broke, once the structural imbalance became undeniable, there was no going back. Gold never returned to $35, silver never returned to $1.50. The old price regime died permanently. We're at a similar inflection point right now. The paper silver market, the fractional reserve system that's kept prices artificially low for decades, is breaking. And when it breaks completely, the old prices disappear forever. But here's what makes today different from 1971. Back then, there wasn't industrial demand for precious metals at the scale we see now. Gold and silver were primarily monetary assets. Today, silver is critical industrial infrastructure. You can't build an electric grid without it. You can't manufacture semiconductors without it. You can't deploy solar energy without it. So when the paper market breaks, and the price resets to reflect physical scarcity, you're not just dealing with monetary demand. You're dealing with industrial desperation, companies that need silver to operate, and they'll pay whatever it takes. The supply situation is even worse than most people realize. Let's talk about mine production. In 2024, global silver mine output reached 820 million ounces. That sounds like a lot until you compare it to demand. Total demand was 1.16 billion ounces, even adding recycling, which contributed 194 million ounces. Supply came to just over 1 billion ounces. The deficit was 149 million ounces. Now, why isn't mine production growing? Because silver is mostly a byproduct. Only about 28% of mined silver comes from primary silver mines. The rest comes as a byproduct from copper, lead, zinc, and gold mining. When copper prices are low, copper mines reduce production, silver output drops as collateral damage, and it takes years to bring new mines online. Permitting, financing, construction, you're looking at a 7 to 10 year timeline minimum. Even if companies started aggressive new mine development today, that supply wouldn't hit the market until 2032 or later. Meanwhile, industrial demand keeps growing. Photovoltaic demand increased 3% in 2024 to nearly 198 million ounces. Electrical and electronics demand grew to 460 million ounces. The automotive sector, driven by electric vehicles, is consuming more silver every year. This is a structural deficit. It's not going away. And every year it continues. Above-ground inventories shrink further. Here's where it gets personal for you. Because this isn't just about industrial companies scrambling for supply. This is about the money in your pocket, your retirement account, your savings. The U.S. national debt just crossed $38 trillion. Let me put that in perspective. Interest payments on that debt in the first quarter of fiscal year 2026 hit $179 billion. That's an 11.9% increase over the previous year. Interest payments now exceed the entire defense budget. When a government is spending more on interest than on its military, that's a debt spiral. There's no way to grow your way out of it. The only options are default or inflate the debt away, and we all know which option they'll choose. The Federal Reserve's balance sheet still sits at $6.58 trillion. That's down from the peak, but it's still triple what it was before the financial crisis. All those dollars the Fed created didn't disappear. They're circulating through the economy, bidding up asset prices, and eroding purchasing power. Inflation, as measured by the CPI, ran at 2.7% year-over-year in December 2025. That's the official number. The real inflation rate, if you calculated it the way they did in 1980, is much higher. Food prices, energy prices, housing costs, they're all up double digits over the past few years. This is why people are moving into hard assets. Gold hit new all-time highs, past $4,600 an ounce in January 2026. Central banks are buying gold at the fastest pace in decades. They're diversifying away from dollars because they see what's coming. And silver, because of its industrial demand and smaller market size, has even more explosive upside when the monetary crisis intensifies. But let me be very clear about something. When I say silver won't go back to $77, I'm not making a prediction about next week or next month. Markets move. Silver is volatile. You could see a pullback to $85 or $80. That's normal price action. What I'm telling you is, the structural floor has moved. The price regime that kept silver trapped below $30 for most of the past decade is over. That world no longer exists. Here's why. The physical market has decoupled from the paper market. Between December 30th, 2025 and January 1st, 2026, something remarkable happened. Physical silver was trading at premiums of 40% to 60% over the futures price in certain markets. Dealers in Singapore reported orders booked in December wouldn't be delivered until March. Chinese prices in Shanghai traded at a $10 premium over London after accounting for import taxes. That kind of dislocation doesn't happen in a healthy market. It happens when the paper price is a fiction and the physical market is setting the real price. And every time this happens, every time physical demand overwhelms paper supply, the paper market loses credibility. Investors stop trusting the futures price. They demand physical delivery, and the fractional reserve system gets exposed. We saw this in March 2020 when the pandemic hit. Refineries shut down. Logistics froze. Physical premiums spiked to $8 over spot. The LBMA, the London Bullion Market Association, had a near crisis because banks couldn't source enough physical metal to settle contracts. That crisis passed, but it revealed the vulnerability. And now, with 5 straight years of deficits, with industrial demand accelerating, with monetary conditions deteriorating, that vulnerability is becoming permanent. Let's talk about what happens next. Because this is where most analysts get it wrong. They look at the current price and try to extrapolate. They draw trend lines and set targets. But this isn't about trends. It's about phase transitions. Think about water. At 211 degrees Fahrenheit, water is hot. At 212 degrees, it boils. 1 degree makes all the difference. The physical properties change entirely. Silver is approaching a similar phase transition. For years, the market has absorbed the deficit by drawing down inventories. Those inventories are now critically low. When they run out, when there's literally no more silver available to meet demand, the price doesn't just go up gradually, it explodes. We've seen this before in other commodities. In 2007, rhodium went from $2,000 an ounce to over $10,000 in 18 months because auto catalyst manufacturers got caught in a supply squeeze. In 2021, palladium spiked to $2,800 an ounce. For the same reason, silver's market is larger, but the dynamics are the same. Inelastic demand meets constrained supply, and price becomes irrelevant. You pay whatever it takes to secure supply, because without it, your production lines shut down. Citibank recently put out a research note saying silver could hit $100 by March 2026, with potential upside to $110 in the second half of the year. That's a major investment bank acknowledging the supply crisis, but even those targets might be conservative. If we apply the same inflation adjustment to silver's 1,980 high that we use for other commodities, you get a theoretical price of $184 per ounce in today's dollars. That's not a prediction. It's a data point showing what silver has done before when monetary conditions deteriorated. Here's what this means for you. And I want to be very direct because this is important. Paper silver will fail you. ETFs, mining stocks, futures contracts, they're all claims on silver, not silver itself. When the system breaks, when the squeeze intensifies, those paper promises will settle for cash, not metal. You'll get dollars, not ounces. Physical silver is the only thing that counts. Coins, bars, bullion you can hold. The premium you pay over spot is insurance. It's the price of having actual metal, not a contract promising metal. Right now, American Silver Eagles are trading at $10 to $12 over spot. Some people look at that and think it's expensive, but compared to what's coming, it's cheap. Because when the paper market implodes, when industrial buyers are competing with investors for every available ounce, those premiums will make today's prices look like a gift. And here's the thing, you can't wait until the crisis is obvious to everyone. By the time silver hits $150 or $200, by the time it's on the front page of every newspaper, it'll be too late. Dealers will be sold out. Premiums will be astronomical. You'll be priced out. The time to act is when everyone else thinks you're crazy. That's how wealth preservation works. You move before the crowd. Let me address the skeptics. Because every time silver rallies, people say it's just hype. They point to 2011 when silver hit $50 and then crashed back to $14. They say it's a trap. Here's the difference. In 2011, the rally was driven purely by investment speculation. It wasn't backed by structural deficits. Mine production was growing. Industrial demand was recovering from the financial crisis, but it wasn't accelerating. When the speculative bubble burst, there was nothing underneath to support the price. Today is completely different. The deficit is real. The industrial demand is growing exponentially. The green energy transition is not speculation. It's policy. Governments around the world have committed trillions of dollars to electrification and renewable energy. All of that requires silver. The electric vehicle market alone will consume an additional 50 to 100 million ounces by 2030 if adoption rates continue. Solar installations are projected to double by 2028, requiring another 80 million ounces annually. Grid infrastructure upgrades, 5G networks, data centers for AI, they all need silver. This demand is structural, not cyclical. It doesn't go away when sentiment shifts, and the supply can't respond fast enough. Even if silver prices double or triple, mine production won't increase significantly for years. The supply response is slow, the demand response is immediate. That's the setup for a historic price move. Now let's talk about the gold to silver ratio, because this tells you something important about where silver is headed. Historically, the ratio between gold and silver prices has averaged around 60 to 1. That means 60 ounces of silver equal 1 ounce of gold. Over the past 2 years, that ratio has been above 80. sometimes reaching 90 or even 100. As of mid-January 2026, with gold at $4,640 and silver at $93, the ratio sits just under 50. That's the lowest it's been in years, and it's still compressing. Why does this matter? Because when monetary stress intensifies, when people lose faith in fiat currencies, they move into precious metals. Gold moves first because it's the most recognized store of value, but then silver catches up and it tends to outperform. Silver is often called the poor man's gold, but that's misleading. Silver has higher beta. It moves faster and further than gold in both directions. When gold rallies 20%, silver often rallies 40% or 50%. If gold continues to $5,000 or $6,000 over the next year, which many analysts expect, and the gold-to-silver ratio compresses to 50 or lower, you're looking at silver potentially reaching $120 to $150 without breaking any historical patterns. And if the ratio compresses further to 40 or 30, which has happened before in crisis periods, you're looking at silver above $200. That's not fantasy. That's math based on historical precedent. Let me tell you what the insiders are doing, because follow the money always works. Central banks bought 297 tons of gold in the first 11 months of 2025, continuing a multi-year buying spree. That's official sector demand running at the highest levels since the 1960s. Why? Because they're diversifying away from dollars and euros. They see the monetary system fraying. Large investors are moving into precious metals. Silver ETF holdings increased 18% through November 2025, adding 187 million ounces. That's the strongest inflow since 2020 during the pandemic panic. Mining companies are hedging less and holding more. Producer hedging activity, which had been dormant for years, returned slightly in 2025, but in nothing like historical levels. Why? Because management teams believe prices are going much higher. They don't want to lock in $90 silver when they think it's going to $150. Even billionaires are making moves. Elon Musk's positioning around supply chains isn't isolated. Savvy wealth managers are telling their clients to allocate 5% to 10% into physical precious metals as insurance against currency devaluation. These are the people who have access to the best information, the best analysts, the best data. And they're moving into silver. Here's what nobody wants to say out loud. The system is built on trust. Trust that the dollar holds value. Trust that governments will honor their debts. Trust that banks will return your money when you ask for it. But what happens when that trust breaks? We saw a preview in March 2023 when Silicon Valley Bank collapsed. In one weekend, people realized their deposits weren't as safe as they thought. The FDIC stepped in, but the cracks showed. We saw it in 2008 when Lehman Brothers failed and the entire financial system nearly imploded. The Federal Reserve had to create trillions of dollars to keep the lights on, and we're seeing it now in slow motion. Currency devaluation, rising debt, geopolitical chaos, supply chain fragility. These aren't isolated events. They're symptoms of a system under stress. When that system finally breaks, and I'm not saying it'll happen tomorrow, but it will happen, physical assets are the only things that survive. Silver, gold, real estate, productive land. Tangible things that can't be printed or diluted or confiscated with a keystroke. And among those assets, silver stands out because of its dual nature. It's both a monetary metal and an industrial necessity. Governments can't print it, manufacturers can't substitute it, and the world is running out of it. Let me make this practical. What should you do? First, understand that physical silver is not a trade. It's not something you flip for a quick profit. It's insurance. It's wealth preservation. You buy it and you hold it. Second, buy incrementally. Don't try to time the exact bottom or wait for a perfect entry. If you believe the structural story, which the data overwhelmingly supports, then dollar cost averaging makes sense. Buy a little every month. Average your costs over time. Third, focus on liquidity. American Silver Eagles, Canadian Maple Leafs. These are recognized coins that you can sell anywhere in the world. Generic bars are fine too, especially from known mints. Avoid numismatic premiums unless you're a serious collector. You're buying metal, not collectibles. Fourth, take physical possession. Store it yourself in a safe or a private vault, or use a reputable third-party storage facility that's fully allocated and insured, but make sure you can get your metal if you need it. If you don't hold it, you don't own it. Fifth, be patient. Silver is volatile. You'll see days when it drops $5. You'll see weeks when it goes nowhere. None of that matters if the structural thesis is correct. The deficits are real. The demand is growing. The paper market is breaking. Those facts don't change because of day-to-day price swings. This is the moment. Not because silver hit $93. That's just a number. This is the moment because the fundamentals have aligned in a way they haven't in decades. 5 straight years of deficits eating into above-ground inventories. Industrial demand accelerating from the green energy transition. A paper market that's losing control of price discovery. Monetary conditions that scream inflation and currency debasement, and a supply response that's 7 to 10 years away, even if it starts today. Every piece of the puzzle is in place. The question isn't whether silver goes higher. The math says it has to. The question is whether you position yourself before the rest of the world figures it out. Because when Tesla and Samsung and every solar manufacturer on Earth realizes they're competing for a shrinking pool of physical metal, when pension funds and sovereign wealth funds start allocating even 1% of their portfolios to silver, when the paper market finally breaks and forces cash settlement, the price will be so far above $93 that today will look like ancient history. This isn't going back to $77. It's not going back to $50. The old price regime is dead. We're in a new world now, one where silver's true value as both a monetary asset and industrial necessity is finally being recognized. The window for accumulating physical silver at remotely reasonable prices is closing. Not next year. Not next month. Right now, every day you wait, the premium increases. Every week you hesitate, the inventory shrinks. Every month that passes, the deficit grows larger and the endgame gets closer. If you've been watching silver, if you've been waiting for confirmation, this is it. The confirmation is here. The data is clear, the crisis is unfolding. The only question left is what you're going to do about it. If this makes sense to you, if you see what I'm seeing, hit that subscribe button. We're going to keep tracking this story as it develops, because what happens in the silver market over the next 6 to 12 months will be historic. You don't want to miss it. Drop a comment below. Tell me if you're already stacking silver or if you're just starting to look into it. What's your biggest concern? What's holding you back? And turn on notifications because this market is moving fast. When the next major development hits, when we see another inventory crisis or another spike in lease rates or when prices break through triple digits for good, you'll want to know immediately. This is the great decoupling, the separation of paper promises from physical reality, and silver is at the center of it. Don't wait until everyone else understands. By then, it's too late.